Welcome to this explainer. Okay, today we're tackling something that paralyzes so many of us, and we're going to use cold, hard data to settle the ultimate investing debate. The question is, do you wait for a market dip or do you just buy in right now, even if prices feel terrifyingly high? We're going to break down the real numbers behind sitting on the sidelines waiting for a correction versus throwing your money in at the absolute peak.
Section 1. The patient versus peak investor.
To really wrap our heads around how this works, let's set up a little thought experiment with two very different investors. On the left, we've got investor A. Let's call her Wendy. Now, Wendy is smart. She knows perfect timing is impossible, but she absolutely refuses, to buy at all-time highs. Her strict rule is to sit on her cash and patiently wait for a 10% pullback before she invests. Then over on the right, we have investor B, Bridget. Bridget doesn't wait around at all, but man, she has terrible luck. Literally every single year, Bridget manages to invest her money on the exact absolute peak day of the market.
So looking at these two strategies side by side, you've got to ask yourself, who actually comes out on top here? Intuitively, you'd probably think Wendy wins by a mile, right? She's the one avoiding expensive markets, she's buying at a discount, while Bridget is just getting totally crushed by her epically bad timing. Well, the reality is probably going to shock you.
Section 2. Data on all-time highs.
Researchers at the Archbridge Family Office actually ran the numbers on this exact scenario. They looked at S&P 500 data all the way back to 1990, and the results are just completely counterintuitive. Historically speaking, investing your money immediately, whenever the market hit a new all-time high, actually produced higher average returns than waiting around for a 10% dip. It literally even beat just investing on totally random days.
I know that feels completely backwards. Why on earth would buying at a record high beat patiently waiting for a sale? Well, healthy markets don't just hit one single high and then immediately collapse. All-time highs actually tend to cluster together. They happen in bunches during really strong bull markets that are driven by actual tangible economic expansion, solid periods of earnings growth, and heavy investment flows. So while Wendy is just sitting there in cash, waiting for a 10% dip that might literally take years to show up, the market is just continuing to march higher and higher without her.
Now sure, if Bridget invests right before a massive crash, like in 2000 or 2008, yeah, her portfolio takes a huge painful hit. But remember, she isn't just investing once, she invests every year. That means her earliest investments have decades to recover, compound, and grow. A market peak today often just looks like a tiny little valley 20 years from now. Think of it like planting a tree. Does it really matter if you planted it on the sunniest day or the cloudiest day of the year? Not really. What matters is that you got it in the ground and gave it decades to grow. By waiting, Wendy is paying a massive opportunity cost in missed compounding, missed dividends, and most importantly, missed time.
Moving on to Section 3, the cost of missing out.
So if the data is this clear, if buying at the absolute peak mathematically beats waiting for a dip, why do we constantly trick ourselves into sitting on the sidelines? Well, it basically comes down to psychology, specifically loss aversion. As humans, we feel the pain of a loss way more intensely than we feel the pleasure of a gain. When markets are flying high, our brains are literally screaming danger at us. We just want to avoid the regret of buying at the top only to see it drop the very next day. But acting on that fear, it carries a pretty devastating hidden price tag.
Let me put some numbers to exactly how devastating that can be. A study by Hartford Funds looked at decades of S&P 500 data to measure the impact of missing out on the market's absolute best days. And they found that an investor who missed just the 10 best days over a 20-year period saw their total returns cut by more than half. Think about that. Just 10 single days out of 2 entire decades, and half your money is gone.
And it gets so much worse if you stay on the sidelines just a little bit longer. That same study found that if you miss the 20 best days, those total returns dropped by over 70%. Trying to wait for a better price essentially guarantees that you're going to miss the exact days that matter the most for your portfolio.
And here is the absolute catch, the cruel irony of this whole thing. Those best days we just talked about, they usually don't happen when the sun is shining and the news is great. They almost always happen right in the middle of highly volatile periods, usually immediately following a crash, when fear in the market is at its absolute highest. So, investors who wait for the dust to settle and for perfect clarity, they end up completely missing the recovery altogether.
Section 4. Consistency beats market timing. So look, if buying at the wrong time feels completely terrifying, but waiting around just destroys your long-term returns, what's the actual game plan? The practical solution here is dollar cost averaging. The data strongly suggests that regularly investing a fixed amount, regardless of what the market is doing that day, week, or month, works infinitely better than trying to perfectly time your entry points. It just proves that consistency beats perfection. It basically removes you and your flawed human psychology from the equation entirely.
Section 5. The hidden concentration risk.
Now, before you take all this research and blindly dump every single dollar you have into one standard S&P 500 index fund, we absolutely have to address a massive caveat about the modern US market. Research from Rockefeller Capital Management found that right now, technology stocks alone make up roughly 41% of the entire S&P 500. Honestly, this is a level of concentration risk we genuinely haven't seen since the height of the dot-com bubble. You might look at your portfolio and think, great, I'm buying 500 independent companies. But in reality, you are incredibly heavily exposed to just one single sector.
To really put this lack of diversification into perspective, let's look at some data from T. Rowe Price. They point out that the MSCI All-Country World Index contains over 25,500 stocks globally. The S&P 500, obviously, has about 500. That means the broad global index holds roughly 50 times the number of companies as the S&P 500 does.
And it goes even deeper than that. Guinness Global Investors points out that if you compare the standard market cap weighted S&P 500 to an equal weighted version, meaning the exact same 500 stocks just balanced evenly, a massive performance gap appears. This is a huge tell. It reveals just how heavily the index's recent performance is being propped up by a very small handful of mega-cap tech giants, rather than broad, healthy growth across all sectors of the economy.
So, what is our final verdict on the S&P 500 when we put all this data together? Well, historically speaking, it has delivered absolutely excellent returns. And over the long haul, it has undeniably outperformed the broader MSCI World Index. That's largely thanks to the sheer strength and innovation of US companies. But we have to be honest, it is highly reliant on specific tech giants right now, and it is significantly less diversified than other broader indexes. The bottom line is, if those few mega-cap companies stumble today, the whole index doesn't just fall a little bit, it falls specifically because they are dragging it down.
We have definitely covered a lot of ground today. Now that you know that time in the market mathematically beats time in the market, but you also clearly understand the very real concentration risks lurking in today's US index funds, I want to leave you with one final very important question to ask yourself. Are you missing the market's best days while waiting for the perfect one? Think about Wendy, think about Bridget, and most importantly, think about your own strategy moving forward.